Welcome to the Daily Consolidation, your 15-minute briefing on today's market action. We break down the day's most important moves on Wall Street, delivered right after the closing bell. Please note this is an AI-generated podcast, and the views shared here are for educational and informational purposes only. Nothing we discuss should be considered personalized financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now let's dive in. So, today, November 10th, wow. The market really delivered a massive reversal. I felt like it just wiped away all that anxiety from the end of last week.
Yeah, it really did. If you were feeling cautious coming into Monday, well, the tape changed its tune pretty quickly.
And the main driver here, it wasn't some surprise data point because, well, we still don't have a lot of that critical economic data, do we?
No, exactly. The catalyst was really about politics easing up.
The shutdown.
That's the key takeaway. After, 40 days? This political vacuum seems to be resolving. The market saw that bipartisan Senate bill advancing and just breathed a huge sigh of relief.
It felt immediate. You called it aggressive earlier. Can you put some numbers on that? Just how broad was this response?
That was pretty much everywhere. The S&P 500 surged over 1.5%, got above 6,830.
And the Nasdaq led again?
Yep, Nasdaq jumped more than 2%. But it wasn't just stocks,
Right, cross-asset. What else moved?
We saw that synchronized buying. Bitcoin, for instance, popped back above $106,000. That's about a 4% climb.
Okay.
Gold had a strong day, too, up about 1.85%. And naturally, the dollar weakened a bit. So this one day basically erased most of last week's losses.
And that collective relief, it makes total sense when you think about the sheer lack of information we've been dealing with.
Right.
I mean, the Federal Reserve making its October rate decision without the jobs report, that's unprecedented, right?
For the first time ever, yeah. That kind of data vacuum just injects risk into everything, whether you're running the Fed or just managing your own portfolio.
So today really shows how much the market just values basic functioning government.
Absolutely. Take away that political tail risk, and suddenly capital feels freer to move back into areas that got hit hard.
Okay, speaking of getting hit hard and then recovering, let's talk tech. That sector sold off brutally last week. Everyone was worried about valuations. Today, biggest advance since May.
Yeah, the rebound in those megacaps, the Magnificent Seven, it was really stark.
What were the signs? What specifically told you leadership was back, at least for today?
Well, you saw Nvidia rallying, 3-4% during the day? Alphabet, Amazon, both up around 3%. But maybe the most telling signal, for me anyway, was Microsoft.
Snapping the losing streak.
Exactly. It finally rose after an 8-day losing streak. That was its longest daily slide since, I think, 2011.
Wow.
When a name like Microsoft sells off like that, day after day, it signals real nervousness. So turning that around, even for a day, it's a powerful sign that the immediate fear has kind of lifted.
Okay, but whenever we see these big index rallies, you always got to look underneath, right? Check the market's health. Did this rally actually bring broader participation?
It was definitely healthier than last week. I mean, 9 out of the 11 S&P sectors finished positive. That's a big improvement.
I sense a but coming.
Well, yeah, the breadth issue, that concentration problem, it's still pretty acute. If you look at the percentage of stocks trading above their 50-day moving average, it's still hovering around only 40%. And that's actually one of the narrowest readings we've seen in, 2 decades.
20 years. Wow. So the indices are yelling all clear, but the gains are still packed into just a few big players.
Pretty much. It confirms that concentration risk is still very much a factor.
And look at the sector leadership today, outside of tech. Consumer staples led the gains, up 1.5%. Energy utilities also strong, up 1.4%.
Right. Some defensives in there, too.
Doesn't that kind of undercut the risk-on narrative a bit? I mean, when people rush into staples and utilities on a day the Nasdaq is flying, it feels less like conviction about growth and more like, relief buying across the board.
That's a really sharp point. It does suggest this was more of an everything rally, driven mostly by that political fear just vanishing, rather than some new, strong belief in economic acceleration.
So people just bought what looked beaten down.
Yeah, or what felt safe, maybe regardless of its cycle exposure. It kind of speaks to maybe the fragility of the enthusiasm right now.
And that fragility seems amplified by this tension between earnings and valuations, doesn't it? Q3 earnings, objectively, they've been solid.
They have. Profits up, 14.6% year over year. And most companies, I think it's over 83%, beat their EPS estimates.
Right, EPS, earnings per share, that key profitability number. So the fundamentals look decent, but the market's still punishing names like, say, Palantir last week. It beat estimates, but still plunged. Why?
Because the market is priced for, well, perfection. The S&P 500 right now trades at a forward PE ratio.
At least to earnings.
Right, of 23.1. And for anyone tracking, that PE tells you how much investors will pay for each dollar of expected future earnings. 23.1 is a 3-year high.
So zero room for error.
Exactly. When valuations are that stretched, a company can beat its current numbers. But if the guidance, the outlook for the future, isn't absolutely stellar, the stock gets hammered. That's the tightrope growth investors are walking.
Okay, let's shift gears a bit. Fixed income. If stocks felt massive relief, did bonds buy into that conviction?
Only modestly. On a risk-on day like today, you usually see demand for safe havens like treasuries pull back a little.
Right.
And that's what we saw. The 10-year treasury yield, it ticked up just over 2 basis points, ended around 4.114%. Not a huge move, but it confirms that fear factor eased off.
What about corporate credit? Last week, we talked about serious stress signs there, those investment-grade spreads widening out so fast. Did that continue?
Thankfully, no. That stabilized today.
Mm-hmm.
And that's actually a pretty crucial sign.
Why is that so important?
Well, when those IG spreads jump like they did last week, they went from around 75 basis points to 120 in just 5 days. That signals real anxiety about companies being able to handle their debt, about the economy.
Got it.
So seeing that stabilize today suggests maybe that big repricing of credit risk has paused, at least for now, pending more data.
Which brings us right back to the Fed and this shutdown ending. You'd think less political risk makes their job easier, but maybe not because of all that delayed data.
Oh, it potentially makes the short term much harder, much more volatile. Chairman Powell already warned that a December rate cut is, quote, far from a foregone conclusion.
Right.
But now, if the government reopens this week, the Fed and the market are about to get hit with a ton of backlog data. September, October, jobs reports, CPI, inflation figures, retail sales.
A data fire hose?
Exactly. All hitting potentially around the same time, right before that December 10th and 11th meeting.
So for you watching the markets, that means weeks of crucial info getting crammed into maybe just a few days or weeks. How do you even process that risk?
You just have to anticipate sharp moves. If that data comes in hot, strong jobs, sticky inflation rate cut hopes could fade fast, and volatility could spike.
And the opposite.
If it shows the economy really is cooling significantly, the market will probably price in that cut almost immediately. And you've got Fed officials sending mixed signals too. Governor Miron pushing for a big 50 basis point cut, while others dissented against easing just recently.
So no clear consensus inside the Fed, plus a data deluge. Makes their job tough and makes predicting them tough for investors.
Incredibly difficult right now.
Okay, before we hit commodities and crypto, let's quickly touch on real estate. Mortgage rates seemed pretty stable near their lows.
Yeah, the 30-year fixed rate is holding around 5.99% on average. That's, more than half a percentage point better than a year ago.
Which sounds good, but
the affordability crunch is still very real. Despite that rate improvement, housing turnover is at its lowest rate in maybe 30 years. Only about 2.8% of homes have actually changed hands this year.
And that's the rate lock-in effect we've talked about.
Exactly. People sitting on those old 3% or 4% mortgages just can't afford to sell and buy again at nearly 6%. So rate stability is nice, but we probably need much bigger, sustained drops to really unlock housing inventory.
Okay. Now, let's look where the action was really explosive today, that cross-asset picture. Commodities, crypto, really reinforcing that synchronized risk-back-on theme.
Definitely.
Yeah.
And the moves in precious metals, they suggest there's still some structural support there, even with U.S. political risk easing. Gold moved back over that big $4,000 psychological level.
But silver was the real story.
Silver was the standout,
Yeah.
Surged over 3.2%. And technically, it broke above $50 an ounce.
That $50 level for silver feels like a big deal, doesn't it? More than just a one-day trade.
It really is. Analysts are watching this closely. It's close above that resistance, reinforces what some are calling a major technical breakout from a pattern that goes back like 45 years.
Wow, 45 years.
And you see structural support for gold, too. It's up, 55% year to date? A lot of that is central banks diversifying away from fiat currencies. They bought around 220 tons net in just Q3. They see it as a hedge.
That structural theme leads nicely into crypto. Bitcoin bounced hard after dipping below $100 K last week. What drove that 4% recovery today back above $106,000?
It was a mix, really. Macro relief from the shutdown news helped, for sure. But we also saw institutional flows stabilize after pretty big outflows last week, about $1.3 billion net left.
Okay, any specific technicals?
Yeah, a couple of things. Funding costs eased off. The SOFR rate moved down a bit. Lower funding costs can make it cheaper to lever up, which often helps risk assets like crypto. And derivatives open interest climbed too, about 6.8%.
Interesting. And weren't some big players buying that dip last week?
They were. MicroStrategy, the big corporate Bitcoin buyer, their filings showed they were accumulating during that weakness. Their average price was just over $102,500.
So big money may be seeing $100 as a key support level.
It certainly signals that some institutional players view that $100,000 mark as pretty significant, maybe a structural floor, which could provide some underpinning for this rally, regardless of the day-to-day macro noise.
Okay, so looking ahead now, the political dust seems to be settling. What's the next really big catalyst on the calendar you're watching?
For me, it absolutely has to be Nvidia's earnings. They report on November 19th.
The last of the Magnificent Seven this cycle.
Exactly. And the expectations are just sky high. Analysts are looking for $1.23 in EPS on almost $55 billion in revenue.
Wow.
Their results, and especially their guidance, will be like the market's final exam on whether this massive AI infrastructure spending can really sustain these kinds of valuations. If Nvidia disappoints, well, those PE ratios we talked about could face some serious pressure.
So let's frame the possible paths forward for you, the listener, trying to balance today's big rally with those underlying risks. What's the bull case? How does this rally keep going?
Okay, the bullish scenario, it kind of requires everything to go right.
Yeah.
The government reopens smoothly. That flood of backlogged economic data comes in okay, shows resilience, no big collapse in jobs. And crucially, Nvidia delivers. Strong results, strong guidance, validating that whole AI spending narrative. If all that clicks, yeah, this relief rally could definitely extend towards year-end.
Okay, and the flip side. What brings back last week's fear? The bear case.
The bearish scenario is basically where those risks we sort of pushed aside today suddenly bite back. If that delayed data does show the labor market weakening significantly, maybe that negative 60,000 October jobs number people worried about actually happens.
Or the Fed holds off on cutting rates.
Right. Or if the Fed sees the data and decides, nope, too soon, we skip the December cut, that would hit market expectations hard. Combine that with any kind of miss or weak guidance from Nvidia, and yeah, the market could easily retest those lows from last week pretty fast.
So boiling it all down, what's the final analytical takeaway from today's action? How should you frame this?
I think today was fundamentally a relief rally. Plain and simple. Driven by less political uncertainty as a shutdown risk faded.
Okay.
But, and this is the important part, those deeper economic worries that drove last week's selling. The jump in job cuts, slowing consumer sentiment, those wider credit spreads. Those issues aren't resolved, they're just postponed, maybe, until we get the actual data.
So expect more bumps.
I'd say volatility is likely to stay pretty high until the market actually digests that data dump and we get the final word from Nvidia. The market's still very reactive right now. That's all for today's episode of the Daily Consolidation. For more daily market analysis, subscribe, and we'll see you at the next close.